Investment appraisal. What is an investment? An investment is the purchase or creation of a non-current or fixed asset with the sole objective of making future gains. For example, purchasing a machine or a plant. What is investment appraisal? Investment appraisal is the process of evaluating the attractiveness of an investment proposal. The proposal could be acquiring or replacing a non-current or fixed asset, opening a new branch, or introducing a new product. It is an integral part of capital budgeting and may be applied to areas other than those mentioned above. For example, marketing, training, etc. Pause the video to look at some of the questions that need to be answered when making an investment. Techniques of investment appraisal. The 4 financial techniques of investment appraisal that you will be learning about are: first, the payback period; second, the accounting rate of return, also known as the ARR; third, net present value or NPV; and fourth, internal rate of return or IRR. Method 1. The payback period. This is the period required for the return in the form of net cash flow on an investment to repay the sum of the investment. In other words, it measures how long an investment takes to pay for itself. The time value of money is not taken into account. All things being equal, a shorter payback period is better than a longer one. Let us look at an example taken from my book, Revising A-Level Accounting, a Study Guide. Pause the video and study the information given carefully. Solution. Let us first look at Project A. In year 0, the project was fully paid for to the tune of $100,000. In year 1, with a cash inflow of $20,000, the balance is now $80,000. In year 2, with a cash inflow of $30,000, the balance is now $50,000. In year 3, with a cash inflow of $50,000, the project has paid for itself. Therefore, the original outlay of $100,000 is paid back after 3 years in Project A. Let us look at Project B. In year 0, there is a cash outflow of $100,000 when the Project B was paid for. In year 1, with a cash inflow of $10,000, the balance is now $90,000. In year 2, with a cash inflow of $25,000, the balance is now $60,000. In year 3, with a cash inflow of $30,000, the balance is now $35,000. In year 4, with a cash inflow of $40,000, we now finally have the project paying for itself. At the end of year 3, $35,000 still remains to be paid back. Assuming that the net receipts accrue evenly throughout the year, the initial outlay will be recouped in 10.5 months. That is, $35,000 balance from year 3 divided by $40,000 cash inflow in year 4. Therefore, the payback period is 3 years, 10.5 months. Note: Project A would appear to be the better of the 2 projects, as the period of risk is less than that of Project B. However, much more information would be necessary in order to make a balanced decision between the two options, such as the life expectancies and comparative profitabilities of the two projects. Non-financial factors, if any, must also be considered. Accounting rate of return, or ARR. The accounting rate of return is the average profit expressed as a percentage of the average investment. The formula is ARR is equal to average profit, which in turn is incremental revenues minus incremental expenses, including depreciation, divided by average investment times 100. Note, first, average investment is equal to initial investment plus any scrap value divided by 2 plus additional working capital required. Note 2, the average here means the arithmetic mean. Note 3, the profit is incremental operating profit, that is, additional profit as a result of the investment. ARR is often used internally to aid decision-making when selecting projects. It can also be used to measure the performance of those projects. It is similar to payback in that it does not take into account the time value of money and does not adjust for greater risk to longer-term forecasts. However, payback leads to overly conservative decisions as opposed to ARR that tends to favor higher risk decisions. The ARR is also known as the average rate of return, or the unadjusted rate of return, or the financial statement method. Let us look at an example taken from my book, Revising A-Level Accounting, a Study Guide. Pause the video and study the information given carefully. You are required to calculate the accounting rate of return. Solution. The ARR, or the accounting rate of return, is equal to 90,000, which is the incremental revenue, minus 40,000 cash operating expenses, plus 20,000 depreciation as per working 2, times 100, divided by 180,000, which is the initial investment, divided by 2, to give us an ARR of 33.3%. Net present value. The net present value of a project or investment is calculated by discounting cash flows from the project in the future and comparing it with the initial investment in the project. A positive NPV suggests that the project is worthy of further consideration. The larger the value of the NPV, the better. Here is an example taken from my book, Revising A-Level Accounting, a Study Guide. Pause the video and study the information given carefully. Note the discounting factor at 10%. A discounting factor is the value used to discount cash flows. They can be calculated, but are available from tables where the present value is $1, and these are normally given. Solution. Year 0, let us take project G. The discounting factor is 1, and there is an outflow of $100,000. In year 1, with the discounting factor multiplied by the net inflow of $30,000, we get an NPV of $27,270. In year 2, with the discounting factor multiplied by a net inflow of $25,000, the NPV is $20,650. In year 3, with the discounting factor multiplied by the net cash inflow of $20,000, we get an NPV of $15,020. In year 4, with the discounting factor at the rate of 10%, multiplied by a cash inflow of $15,000, we get an NPV of $10,245. In year 5, with the discounting factor multiplied by a net cash inflow of $35,000, we get an NPV of $21,735. Adding all the positives and minusing it from the cash outflow, we get a negative of $5,080 NPV for Project G. Now let us look at Project H. In year 0, there is a cash outflow of $100,000 multiplied by the discounting factor. We get an NPV of negative $100,000. In year 1, with a net cash inflow of $20,000 multiplied by the discounting factor, the NPV is $18,180. In year 2, with a net cash inflow of $35,000 multiplied by the discounting factor, we get an NPV of $28,910. In year 3, with a net cash inflow of $40,000 multiplied by the discounting factor, we get an NPV of $30,040. In year 4, with a cash inflow of $50,000 multiplied by the discounting factor at the rate of 10%, we get an NPV of $34,150. In year 5, with a net cash inflow of $15,000 multiplied by the discounting factor at the rate of 10%, we get an NPV of $9,315. Adding all the positives and minusing it from the negative, we get a positive NPV of $20,595. Therefore, we can see that Model H has a positive NPV of $20,595, indicating that the future net receipts at present day value exceed the initial cost of the investment. Hence, Lambert Limited should purchase Model H and not Model G, which has a negative NPV of $5,080. Internal rate of return, or IRR. The internal rate of return is the discounting rate which equates the discounted net receipts from a project to its cost. It is the rate at which the NPV is 0, as indicated in the diagram on the left. It is therefore the rate at which the NPV of costs, negative cash flows, of an investment equals the NPV of the benefits, positive cash flows, of an investment. There are 2 steps in the calculation of the IRR. The steps are: first, use 2 different rates to discount cash flow. The rates have to be sufficiently far apart to give one positive and one negative NPV. Second, use the formula given, where X is equal to the rate giving the positive NPV, PQ is equal to the difference between the two rates, AC is equal to the positive NPV, and AD is equal to positive plus negative NPVs, disregarding the signs, or taking the absolute values of both NPVs. This is an exhibit taken from my book, Revising A-Level Accounting, a Study Guide. More information about this and other books will be given at the end of this presentation. A company has $100,000 to invest in a project. The net cash flows for each of the first 5 years is estimated to be $28,000. Required: calculate the IRR using the rates 10% and 14%. You will normally be given the discounting factors in the question. Let us now calculate the NPV at 10%. That is equal to $100,000, which is the initial outlay, minus $28,000 positive net cash flow every year, times the discounting factor. Note, these are the discounting factors at the rate of 10% for 5 years. This gives us a positive $6,120. This is the NPV at the rate of 10%. Now let us calculate the NPV at the rate of 14%. That's equal to $100,000, which is the initial outlay, minus $28,000 positive net cash flow, times the discounting factors at the rate of 14%, which will be given to you. This gives us an NPV of a negative $3,904. The IRR is therefore equal to 12.44%. Note the denominators: 6,120 plus 3,904 should be taken as positives or absolute values, ignoring the negative sign. Some important points to note regarding investment appraisal. If a company is operating under a capital rationing constraint, it should rank possible investments in order to achieve the highest possible overall net present value by their profitability indexes and not by their IRR or NPV or investment costs. Profitability index is equal to NPV divided by capital cost. Second note, working capital is always an outflow at the start of the project and an inflow at the end of a project. Third note, factors other than NPV that may be used to determine the acceptability of a project are environmental issues, which are non-financial issues, political issues, which are also non-financial. Is initial finance available or can it be raised? How reliable is forecast for long-term projects? And are existing projects being affected by this project? This is an example adapted from a past paper. Pause the video and study the information given carefully. Note, depreciation is equal to $250,000 divided by 4 to give us $62,500 per year. Also note, fixed costs are equal to $107,500 minus $62,500 to give us $45,000 per year. Solution. Subtracting all the costs of labor, materials, and fixed costs, we get a net cash flow of $90,000 in year 1, $103,500 in year 2, $103,350 in year 3, and $71,100 in year 4. Continuing from the past paper question in the last slide and reproduced on the left, we now calculate the net present value, taking the discounting rate of 10%. In year 1, the net cash flow of $90,000 is multiplied by the discounting factor to give us a present value of $81,810. In year 2, the net cash flow of $103,500 is multiplied by the discounting factor to give us a present value of $85,491. In year 3, the net cash flow of $103,350 is multiplied by the discounting factor to give us a present value of $77,616. In year 4, the net cash flow of $71,100 is multiplied by the discounting factor to give us a present value of $48,561. Adding all the positives and subtracting it from the negative, we get a positive net present value of $43,478. Continuing from the example of the past paper that we looked at in the previous 2 slides and reproduced here on the left, let us now calculate the profit for year 1. The revenue would be $600,000, which is $30 per unit, and $20,000 was the sales volume expected. $30 times 20,000 gives us $600,000. Labor costs at the rate of $15 per unit will give us $300,000. Material costs, as per the working indicator, will be $165,000. Fixed costs, as calculated in a previous slide, is $45,000. Depreciation, as calculated in a previous slide as well, is $62,500. Subtracting all the costs from the revenues, we get a profit of $27,500 in year 1. Let us now do a sensitivity analysis. Sensitivity to sales price is equal to $27,500 divided by the revenue of $600,000 times 100 will give us 4.58%. Sensitivity to material costs is equal to $27,500, which is the profit, divided by the material costs of $165,000 times 100 to give us 16.67%. What does this mean? If the selling price per unit drops by more than 4.58%, or the material costs per unit increases by more than 16.67%, then the project will make a loss. Marie should focus her attention on the selling price per unit, as the profit of the project is more sensitive to this item. The change in the selling price per unit, 4.58%, is a lot less than the percentage change in the materials of 16.67%. More information about AS Accounting, a Study Guide. This book is available at most book outlets worldwide, including Book Depository and Amazon. They are available in hard copy as well as in e-book format. The content of this book matches the latest CRE AS syllabus and is pitched at a level that is extremely workable. The book is written by a qualified and experienced teacher and fills the need for a guide that is solely meant for the CRE AS accounting course. Some salient features of the book are: it unpacks the CRE AS accounting syllabus, IAS terminology has been used, students love the unique question and answer presentation of theory, there are numerous tips for success, and exhaustive exercises for practice. Here are other titles available: AS Accounting Workbook, a write-in workbook that will help you prepare for your examinations, and Revising A-Level Accounting. Please contact me at junebaptista@hotmail.com for more information and for answers.